The new symbol or the currency symbol was designed by D. Vijay Kumar, postgraduate of IIT Bombay, was finally selected by the Union Cabinet on 15th July 2010. The symbol amalgamation of Devanagari Ra and Roman or without the symbol of India rupee came into use on 15 July 2010. After America, Britain, Japan, Europe Union, India is the fifth country to accept unique currency symbol. Currency deposit ratio, it is the ratio of money held by the public in currency that they hold in the bank deposits. Reserve deposit ratio consists of two means vault cash in banks, deposits of commercial banks with RBI. Cash reserve ratio is the fraction of the deposits the banks must keep with RBI. Statutory liquidity ratio is the fraction of the total demand and the time deposits of the commercial banks in the form of specific liquid assets. Quantity theories of money. Quantity theories of money explain the relationship between quantity of money and value of money. There are two given approaches are quantity theory of money and the Fisher's transaction approach and Cambridge cash balance approach. Fisher's quantity theory of quantity theory money is a very old theory. It was first founded in 1588 by an Italian economist Dan Manzatti, but the credit for popularizing this theory recently belongs to the well-known American economist Irving Fisher, who published the book Purchasing Power of Money in 1911. He gave it a quantitative form in terms of his famous equation of exchange. The general form of equation given by Fisher is MB is equal to PT, money value supply, into velocity of money is just over price level and volume of transaction. Fisher points out that in any country during period of time, the total quantity of money MB is equal to total value of goods and services bought and sold. Supply of money is equal to demand for money. This equation is known as transaction equation. It is expressed by P is equal to MB by T. The quantity of money determines the price level, and the price level in turn varies directly with the quantity of money provided V and T remain constant. The above equation considers only currency money, but in a modern economy, banks deposits are credit money and its velocity play a vital part in business. Therefore, Fisher extended his original equation of exchange includes bad deposits. It is equal to MV plus M1V1. It is equal to MV plus M1V1 by T. So the quantity of price level is determined by the quantity of money in circulation M, velocity of circulation of money V, the volume of bank credit money M1, the velocity of circulation of credit money V1, and the volume of trade T. Marshall's equation expresses M is equal to KPY. K is represents the fraction of the real income which the public decides to hold in form of money. P is the purchasing power of money. Y is the aggregate real income of the community. M is the quantity of money. P is equal to M by KY is the value of money. Keynes equation is expressed as N is equal to PK. P is equal to N by K. Inflation is consistent and appreciable rise in the general price level. Inflation is the rate of which the general levels of prices of goods and services is rising, and consequently the purchasing power of currency is falling. Too much of money chasing too few gives cold one state of normal decrease in the quantity of purchasing power. They go here. Types of inflation are creeping inflation, there's mild rise, slowing and foaming, and very mild. Gallop inflation, that inflation or hyperinflation points out unusually high inflation rates that run into 2 or 3 digits. First hyperinflation was 21st century. Zimbabwe's annual inflation rate surged to unprecedented 3,740% at the end of April 2007. Demand pull inflation. Demand and supply play a crucial role in deciding inflation levels for society. For instance, if the demand is high for a product and supply is low, the price of the products increases. Cost push inflation. The cost of raw materials and other inputs rises. Inflation results. And the cost increase in wages paid to labor also leads to inflation. The cost of raw materials and other inputs rises. Inflation results. Wage price spiral. Wage price spiral is used to explain the cause-and-effect relationship between the rising wages and rising prices or inflation. Currency inflation, excess apply of money in circulation causes rise in price level. Excess supply of money in circulation causes price inflation. Credit when banks are liberal in lending credit, the money supply increases and thereby increasing prices. Deficit introduced inflation. Deficit budget is generally financed through the printing of currency by the central bank as a result prices rise. Profit induced inflation. When the firms aim to higher RBI, they fix the price at a higher margin, so prices go up. Scarcity induced inflation. Scarcity of goods occurs either due to fall in production or due to hoarding or black marketing. This also pushes up the price. This tax induced inflation. Increase in indirect taxes like excise duty, custom duty, and sales tax may lead to rise in price. Petrol and diesel. This is called taxflation. Causes of inflation. Increase in body supply. Inflation is caused by increase in the supply of body. Increase in disposable income. Increase in the rise in the national income or reduction in taxes or reduction in the saving of the people. Increase in public expenditure. Government activities have been expanding due to the development and social welfare programs. Increase in consumer spending. The demand for goods and services increases when the people are given credit to buy goods on higher purchase and installment basis. Cheap money policy. Cheap money policy or the policy of credit differential also leads to increase in the money supply, which raises the demand for goods and services of country. Deficit financing. In order to meet its mounting expenses, the government resorts to deficit financing by borrowing from the public and even by printing more currency notes. This raises aggregate demand in relation to aggregate supply, thereby leading to inflationary rise in prices. Black assets activities and money. The black assets corruption increases the aggregate demand. Uses such money lavishly. Black marketing and hoarding reduces the supply of goods. Black marketing reduces the supply of goods. This tends to raise price level for the repayment of public debt. Whenever the government repays its past internal debt to the public, it leads to increase in the money supply. This tends to raise the aggregate demand for goods and services. Increase in exports. When exports are increased, domestic supply of goods decline, so prices rise. When the value of money undergoes considerable depreciation, this may even drain out the foreign capital already invested in the country. With reduced capital accumulation, the investment will suffer a serious setback, such as which may adverse effect on volume of production in the country. Inflation also leads to a hoarding of essential goods both by traders and consumers, thus leading to still higher inflation rate. Inflation encourages investment in speculative activities rather than productive purposes. Effects on distribution. During inflation, debtors are gainers while the creditors are losers. The reason is that debtors are borrowed when the purchasing power of money was high and now repay the loans when the purchasing power of money is low due to rising prices. Fixed income groups. Fixed income groups are worse hit during the inflation because the incomes fixed do not bear any relation with rising costs. Entrepreneurs. Inflation is the boon for entrepreneurs, whether a manufacturer, traders, merchants, or business makers serves as a tonic for business enterprise. They experience windfall gains as the prices of the inventory stock suddenly go up. Investors who invest in fixed interest yielding bonds and securities have too much to lose during inflation. On the contrary, those who invest in shares stand to gain by rich dividends and appreciation in value of shares.